Get out now. I'm your host, Steve Van Metre, and thanks for joining me today. And our lead story today, a major bank triggers a fire sale on assets, causing this to crash by 80%. We're going to talk about who this bank is, what asset they're desperate to unload, and more importantly, why. We're also going to look at how policymakers in another country are dealing with the same issue, and then exactly what the U.S. is going to do, how our central elites are going to handle the same problem when the crisis goes in full bloom here. Plus, we have a sponsor for today's show, Ideal Power. You can find them on the NASDAQ under symbol IPWR, and they're commercializing an innovative and proprietary semiconductor power switch. But what's really interesting, if you missed out on the big GameStop short squeeze, well, guess what? This stock is experiencing a monster short squeeze that we see could send the stock up another 44%. This is not something you want to miss out on, because stocks tend to move big after we feature them on our show. Stay tuned to the end of the show or check out the pinned comment or description for more information. Now let's head over to Bloomberg, where we picked today's story up with a headline as HSBC's profit sinks a whopping $3 billion charge at Chinese banks. And this is a problem because when we talk about the U.S. banking system, we note that the small and mid-sized regional banks are insolvent. They cannot take any sort of financial hit. And here we have a major bank taking a huge blow, and that's causing them to dump assets. Of course, we know who's holding a bunch of those. That's our banks. And here we can see they reported fourth quarter profit fell by a whopping 80% after taking, quote, unexpected charges on holdings in a Chinese bank. That's just one bank, and from selling its French retail operations. So you can just think that when this hits the U.S. banks, as I said, they're already insolvent. We know the data is verifying that. If you can imagine how many banks in the U.S. are going to fail when the commercial real estate space starts to unwind here, and HSBC is just getting a lead on what's coming to the rest of the world. And you can see, though, our confidence in China is still strong, even though one bank stumbled, and we're investing, and we've done 3 bolt-on theirs. In fact, we'll continue to look for bolt-ons, particularly in our wealth management business. Of course, we can note that why the wealth management side? Well, Chinese stocks are starting to rally in a big way. This is something we told our subscribers in our reports. In fact, I just put out videos on 2 trade setups today. Check out the links in the description below for 3 free subscriptions for a free month. But let's continue on here, because HSBC slashes commercial property exposure in the US and the UK to limit losses. This is a problem because this is something that the US banks are sitting on a ton of. The small and mid-sized regional banks make all of their big business on commercial real estate. They're sitting on it. We have not had to write these assets down. And this is coming. And you can see, we're going to look at how another country is dealing with this. And yet, then we'll talk about how the Federal Reserve is likely to handle this as well. Because what we can see is one bank stumbled in China, causing HSBC to take a big hit. Can you imagine what would happen here in the U.S. if we started to see a domino effect across our banking system? Well, let's take a look at why they wanted to unload this commercial real estate, because the bank's U.S. commercial property portfolio is now less than half the size it was before the coronavirus pandemic. This according to the CEO. If last year the bank's exposure to the U.S. market fell 27% to $3.9 billion, the biggest drop of any geography, because everybody knows that the situation here in the commercial real estate space is in dire shape. The banks have not had to go through and write down these values, these properties. The issue is, while HSBC is seeing this ahead of time and trying to unload this stuff as quickly as possible, you'll note they took a hit to their profits. The U.S. banks cannot afford any loss because they don't have enough profit margin to absorb it. They don't have enough cash on hand to deal with these losses. And when this eventually hits, more likely sometime this year, you're going to see bank after bank here go under. And for good reason. They took on risk at a time when the Fed raised rates really aggressively. And now the value of these buildings is just outright crashing. But something else that's coming down is commercial industrial lending, and this is an issue for, again, all banks, but this particular, the U.S. banking system. Here we can see the commercial industrial loans. This is as of last week, is in contraction of 1.2%. Now we know that this is how banks make money, by lending. So these small and mid-sized regional banks are sitting on upside down assets, of course, their commercial real estate loan book, not to mention their unrealized losses on their treasury securities. Talking about making the case for the Fed to get back to zero in a big way, because this is something that banks need. They need to see lending activity here to create deposits, to create revenue, and more importantly, to show that the U.S. economy is growing, that maybe the value of these buildings aren't coming down that much. Of course, if you're wondering why some major companies are now pushing for this go back to the office trend, well, there's a good reason. They see the crash here is coming. Now let's talk about how China is dealing with this, because their state banks now are earmarking $8 billion for property projects. And you might think, wait a minute, are they crazy here? Why would the government do this? Because they understand that if the property sector goes, their banks that are also insolvent are done. And so they're coming in and putting support under this, which starts to lead to the question is, will the U.S. do that? Well, we already heard from the Federal Reserve saying, well, we know there's going to be some banks that fail. We expect that. That's just natural of any cycle, and we'll just have them merge with other banks. The problem is, if you take rot and you merge it with rot, you don't get gold at all. And China realizes this. That's why they're pumping money into their banking system in a big way. And the announcements came after Beijing urged local authorities last month to better support financing needs of developers and draft lists of eligible projects. Now, we noted this would not have much of an effect, other than it may give some confidence to some marginal buyers, because the issue is we're going to look around the world here in a moment at what's going on, and we're going to see that this isn't a matter that the global economy is booming and that China just is in the wrong place at the wrong time and needs some monetary and fiscal support here. The issue is the whole global economy is trending down, and no matter of how much they pump into the projects here through lending, they're not going to save the whole system. And policymakers ordered banks to step up lending to the property sector, which saw credit growth last quarter slow to the weakest in more than a year, undermining the ability of developers to complete homes because they couldn't access credit. But more importantly, when we see a contraction of credit in a debt-based system, all that does is validate that the economy underneath is slowing down. Now, for the banks, because the commercial banks create money when they lend, well, money is destroyed as principal payments are made. Whether it's to pay off a loan or as part of a regular monthly coupon, money is destroyed from the system. And that's not a good trend here. So Beijing's trying to turn this around the only way they can, which is force the banks to lend to these insolvent property developers and hope something magic happens. Here in the U.S., we don't have that ability because the government just doesn't have that control. Maybe they will at some point, but not today. And the four big state lenders all vowed to actively meet reasonable financing demand. Of course, they were probably ordered to by Beijing, of developers and eligible products under the coordination mechanism. Since late January, 5 national state-owned banks have been reviewing more than 8,000 residential projects on potential whitelists, and this still is not making a big difference as authorities are struggling to arrest a slowdown in China's property market, which saw new home sales last month tumble a massive 34.2%. So you can see that China here is indeed in the danger zone, trying to do everything they can to turn this around. And we noted this months ago that China would eventually turn around and say, hey, you know what? We are going to stimulate the heck out of our economy, because otherwise the only choice is to see the banks start to fail, these property developers. Everybody there is insolvent. It's just a matter of, and when the consumers find out, well, now Beijing's panicking, and for good reason, and that's also causing a rally underneath their stock market, because now you can't sell there anymore as China tightens grip on stocks with net sale ban at open and at close. This caused, of course, Chinese equities here that are traded in the U.S. to gap up overnight, bringing nice gains to those who bought that bottom, something we helped you with our reports. Again, check out the links in the description, and while you're there, check out Ideal Power. But while authorities have been ratcheting up curbs on bearish bets for months, The ban on net selling at open and close represents a notable tightening of the government's grip on market activity that risks upending popular strategies used by hedge funds and other institutional investors. Firms affected by the ban are unable to sell more shares than they buy during the first and last 30 minutes of trading. Of course, that means Beijing is now putting a floor under the market that's causing equity prices to rally. The hope there is this creates a bit of a wealth effect and gives people confidence that, yes, the Chinese economy is going to turn around and they can go out and now spend, of course, on the discretionary side, but more importantly, on the housing side to get some of these unfinished projects done, get money flowing back to the banking system and turn everything around. Seems like an ideal scenario, but if you look around China, well, it doesn't look like it's going to play out. Because their neighbor Japan now is downgrading their economic view for the first time in 3 months as we continue to get evidence of a slowing global economy. The government's latest appraisal indicates that the economic recovery is likely to remain tepid after the economy unexpectedly, I love it, slipped into a recession at the end of last year, dragged down by anemic domestic demand. Everyone said the demand was going to surge higher. We said not a chance. This is an unlikely case because too many central banks have inverted those yield curves and money curves, constricted the creation of credit, and all that does is it means asset prices and economic growth must slow. And sure enough, we're starting to see that in Japan, despite all the easing they do. And the government cut its view on production for the first time in 11 months, citing a drop in manufacturing activities, with some automakers temporarily halting production and shipments. We notice around the world here, with the exception of the U.S., which has seen a little bit of a manufacturing renaissance. I believe this has everything to do with this holdup that's going on in the Red Sea, that some people are buying here from U.S. factories because of the additional time and cost now to order overseas. It makes it more efficient for them to buy local, but still the issue is around the world we continue to see a slowdown in manufacturing, and the response from political elites is, but that's okay because it's all about services. Well, we'll talk about that in a moment. Because Germany affirms bleak outlook. Remember, they're one of their big export partners is China, to output as growth now down to 0.2% projected for this year, as the largest economy is reeling from manufacturing downturn that in Europe that's raising questions about the future of its key industrial sector. As output shrank 0.3% last year amid weak global demand, something we don't see any signs of picking up. High inflation, which is indeed coming down as demand goes away, and fallout from the loss of cheap Russian energy supplies, and a court decision curbing budgetary spending, putting Germany now on the other side there of China and Europe, looking like their manufacturing sector is going to tank further, something we said likely to happen. Everyone else said no way. And Bundesbank President Joachim Nagel said last week that German output may have shrunk at the start of 2024, suggesting it will be stagnant at best, meaning something much worse is coming, that between January and March. Current sentiment indicators don't point to a noticeable upturn at the start of this year, which is dangerous, but the good news, if there is any, is that the inflation's falling. In fact, they're happy because they managed to bring inflation under control in Europe by absolutely crushing demand. Of course, when you crush demand enough, we know what that means is more and more Germans are going to hit the unemployment line. That will further crush demand. And what you're going to see is this very slow ripple effect around the world as major economy after major economy slows down and decelerates until all of a sudden it hits a wall. But if you're worried, if you're hopeful, that is, that the Fed's going to react, well, don't worry. They're not going to until it's way, way too late. As Fed Sparkin says, inflation data show persistent price pressures. We must do something about this, and that means the government data released last week showed consumer prices for goods decline in January as demand goes away, but that was more than offset by rising prices for shelter and services. This according to Barkin, who didn't bother pointing out that this consumer price index by the hands of the BLS was retuned to put more emphasis on services. Of course, that helps make the case that the Fed could keep rates higher for longer, and we know they want to do that. And you do worry that when the goods price deflation cycle ends, that you're going to be left with shelter and services higher than you like. Well, that's typically true historically. But again, Barkin doesn't mention that. He added that he's looking more closely at the short-term inflation figures now than the year-over-year data. And of course, that means he's looking at the month-over-month data because he's expecting the year-over-year rate of change to fall. Now, the issue then comes back to what will the Fed do when we have a banking crisis here that we know is baked in the cake? And it early, perhaps we'll see it happen in March. As we know, the Bank Term Funding Program and the reverse repo program drains down near zero. What will the banks be forced to do as they're desperate for cash and have all these buildings that start to come due on their loans that they have to write down? Well, all we know is the Fed says at this point will help them merge, but that won't solve the problem because inflation is the issue here, and the Fed will need to get back to zero very quickly. But let's talk about what Barkin mentioned about services inflation. In fact, we have that shown in blue, the services less energy against the consumer price, the headline one in red, both on a year-over-year rate of change. And what I wanted to point out here is that compared to the CPI in red, the services sector inflation moves very slowly, suggesting that even if the headline number gets down to 2%, which we will at some point, the services side will indeed lag, well, until it doesn't. But what's the catalyst behind this? Because as we look around the world, we continue to hear manufacturing slowdown in this economy, another manufacturing slowdown over here, and another one over there. Does that mean that the service inflation comes down? Well, not right away. There's actually another catalyst for that. As here we go to the Philly Fed manufacturing index of the diffusion index against the consumer price index, again, just for services, not the headline, just for services in blue. And what do we know? That manufacturing slowdowns do not immediately lead to a slowdown in services inflation. In fact, we don't see that at all. But what we do now in more modern times as we became a more globally synchronized economy, at least in the initial stages, is a downturn in manufacturing is followed by a slowdown in the services sector inflation. And we see that happening now, even though we're seeing a bit of a resurgence in U.S. manufacturing. But will that last? Will services inflation come down? Well, there is something that does have to happen, and that is coming too. Because we know that when manufacturing sector goes down, people hit the unemployment line. And as more people have unemployment checks to live on, that means their demand goes down. And here we can look at the services sector against the continued claims data that's shown in red. And what do we know? The periods where we see high levels relative to the prior cycle of unemployment claims that stay persistent. Here you can see I highlighted in red. Well, that leads to a big decrease in services demand as consumers just don't have the money to spend on that side of the economy. So despite the fact that we've seen a slowdown here, it will not happen even more until we see a much bigger move in inflation. Of course, not inflation, but in unemployment claims to drive inflation down. Of course, every Thursday we look at that data and the expectation as we continue to see slowdowns hit, we see a lot of corporate layoffs, is eventually we're going to see these continued claims break out on the official data over 2 million, and watch out, it won't stop from there. But somebody who does need to stop is Barkin, because he votes on monetary policy this year, and he said the Fed should wait to cut interest rates until it has more evidence that inflation is firmly on a path to the central bank's 2% target, even though we're very clearly on that path now. This echoing, of course, several of his colleagues. He did not want to comment on the rate path because we know what the Fed does every time is they wait until something blows up and then they cut and head to zero rapidly. They think they've got it this time, but the evidence around the world, the rot in our banking system, what you see, which is HSBC dumping, of course, commercial real estate properties as quickly as they can, getting rid of those loans, suggests that what's coming for the U.S. banks is going to be outright devastating. But something that's going to be a huge boom to your trading account, well, that's the stock for our sponsor today, Ideal Power, which is undergoing a massive short squeeze. You can find them on the NASDAQ under the symbol IPWR. Let's take a look at this company because all the information is in the description and pinned comment below, because they're commercializing an innovative proprietary semiconductor power switch, and this is going to be very very useful because it is proprietary and it's a new disruptive design. It's called Metre, and it has 3 compelling advantages. It does bidirectional switching. It means lower losses equal lower user costs, and smaller and lower cost product designs. Those are massive advantages, and the critical performance characteristics have been validated through testing of hundreds of packaged devices, and this is phenomenal. And what's driving their stock? Well, it's the fact that they have a big serviceable addressable market, looking at total of $7.6 billion for just Metre alone, not to mention their other products. In the short term, they're looking around 1.4 from energy and power and $1 billion from solid state switchgear. Over the long term, the automotive and industrial sectors will see big demand in their projections for their products. Again, check them out, IPWR, because they've got commercial agreements and collaborations, one with the second top 10 global automaker, top 10 global solar power conversion provider, 2 Forbes Global 500 diverse power management market leaders, a tier 1 global automotive supplier, global provider of backup power and energy management solutions, and global power conversion supplier. This company is going to make waves, and one of the things that is making waves right now is their stock price. Let's talk about what happened here recently. They just announced their SimCool was starting to ship. They've got some products in addition to Metre. They've got SimCool and SimCool IQ, and they're estimating 50% gross margins at scale, excluding any benefit from licensing, and we're estimating a potential 44% return from the short squeeze. Now, I want to show you what happens with their stock again on the NASDAQ on the symbol IPWR. You can see when it gets into a consolidation zone and all the sellers are worked at, it just gets squeezed massively higher up into this roughly $13.50 to $13.75 range, and you can see these pullbacks, they just go vertical after that, and you can see this happens repetitively when the stock enters a big, again, pullback before it launches. Here you can see the major pullback here. They had a press release the other day on SimCool, and the stock is taking off. At the time of recording, it was holding most of that big move today, and we can note that this is just settling up a huge short squeeze all the way up into this $13, maybe even $14 range. And if we zoom in here to the 6-month chart, you can see the volume profile as all these buyers are flooding in, driving these shorts out. Again, if you remember the GameStop story, you're seeing here real time with IPWR, and that's why we think this would be a huge boom for your trading account. Remember, put your stop loss levels up that this thing goes vertical like we think it can, raise them up with it. And as always, before you do any trading, be sure to do your own research, because you're under no obligation to purchase any shares with any sponsor that we have. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.